Gold hits record high, silver surges 6% on Friday, while US dollar and Treasury yields strengthen. What logic is unfolding in commodities? Gold, silver, and copper possess both financial and industrial characteristics. Gold has the strongest financial safe haven attribute, copper has the strongest industrial use, and silver falls somewhere in between. Recently, gold reached a record high, silver experienced volatility, and copper showed signs of decline. This indicates that gold's financial safe haven role has been the primary driver behind its price surge. From a financial perspective, we can first look at the rate cut trade. However, since the Federal Reserve's rate cut in September, which came with a more hawkish dot plot, U.S. economic data and inflation have significantly exceeded expectations. Following the rate cut, both the 2-year and 10-year Treasury yields actually increased. Therefore, the rally in commodities cannot be attributed to a decline in risk-free rates. Additionally, the US dollar index and gold are generally inversely correlated. Since gold is priced in dollars, an appreciating dollar typically causes gold prices to fall. A stronger dollar is also usually linked to expectations of Federal Reserve rate hikes. When the Fed raises rates or there's an anticipation of future hikes, the dollar strengthens because U.S. Treasury bonds offer higher returns through interest payments. Gold, which doesn't generate interest, becomes less attractive, pushing its price lower. However, we are now witnessing the unusual phenomenon of both gold and the dollar rising simultaneously. This could be explained by what's known as the Trump trade, where the market expects his policies to stimulate U.S. economic growth and accelerate inflation. Such growth expectations are driving both the dollar and Treasury yields higher. As I have discussed in previous videos, rising long-term Treasury yields reflect the strength of the U.S. economy. In this case, gold's inflation hedge logic comes into play. Higher inflation expectations reduce real interest rates, driving up gold prices. It's important to note that although nominal rates are high, long-term inflation expectations are causing real interest rates to decline, thereby supporting the rise in gold prices. Additionally, Trump's rhetoric has amplified gold's safe haven appeal. If you've been following international news, you're likely aware of recent geopolitical events, which have significantly driven central banks to increase their gold reserves, further pushing gold prices higher. Let's now turn to copper. Copper and gold mirror each other. Copper has weaker financial attributes but strong industrial demand, particularly tied to China's manufacturing sector. During the trading days when China announced what was dubbed epic stimulus, copper prices surged. However, copper has not experienced the same sustained rally as gold due to its weaker financial attributes. This is also reflected in the stagnant oil prices, which, like copper, are primarily driven by industrial demand. Oil's performance is further influenced by supply factors, such as the geopolitical situation in the Middle East and OPEC production capacity. After discussing gold, oil, and copper, we return to silver, which surged 6% on Friday. Silver largely follows the Trump trade, and with its smaller market size, its price movements tend to be more volatile and dramatic. As a result, we see that the investment logic behind precious metals is incredibly complex, involving interest rates, geopolitics, the Trump effect, and various U.S. presidential policies. This complexity is precisely why I've personally moved away from investing in precious metals. The factors influencing their prices are just too multifaceted.